All right, all right, all right. Happy Thanksgiving Eve. Let me go ahead and get everything ready. Hopefully, you guys are enjoying today, getting ready for the holidays. I know some people are in the kitchen right now cooking. I know some people are probably at the store right now in those long lines. But I'm only going to take up about 10 minutes of your time today. Hopefully, you're enjoying family and hopefully you are celebrating love, celebrating togetherness, celebrating family. Because no matter what you decide to celebrate or not to celebrate, I hope you guys are celebrating something in life, and there's always something to celebrate. So today, this Lunch and Learn is going to be all about personal private pension plans or annuities. I'm going to talk about some of the good stuff about annuities and the bad stuff. You know, a lot of times, a lot of these financial instruments, they get a bad rap. Oh, don't invest in the market, you'll lose all your money. Or don't invest in this because of this. Well, listen, there's always some good and there's always some bad to no matter what you decide to invest in. My goal is to make sure that you understand and you make informed, educated decisions. So let me go ahead and share my screen so we can go ahead and dive in. You guys can get back to cooking if you're cooking. Me, I'm going to be eating. I'm not cooking. All right, so let's talk about annuities and the basics of how they work. So a lot of times people come to me and they ask, well, what is an annuity? An annuity is an insurance contract issued by a financial institution with the intention of paying out invested funds with an income stream in the future. So just know that an annuity is an insurance contract. Now, there's going to be three components that you guys have to understand when it comes to designing any type of investment. So the first one is tax, right? What's the tax code? And this is very important because guess what? You can't avoid Uncle Sam. You know, and this is not a tax training. I'm not giving any tax advice, but when designing an investment, you want to know exactly what the tax code is. Uncle Sam needs to know how to treat this money. Is it qualified or is it non-qualified money? Qualified money is basically money that's in your investment accounts, like your 401k, 403b, TSPs, any type of investment account. That's qualified money. Non-qualified money is consider that paycheck money, right? Or money that's sitting in your bank account or a general investment account. So the next component that you have to understand when designing an investment is, well, what's the investments? And that's very important. Where is the money being invested? Are you growing your money? Are you losing your money? Is it growing fixed? Is it growing variable? Or is it growing with an indexing strategy, which I will go over a little bit later when it comes to your accumulation phase of your money? And the last component is, well, what's the vehicle? What are we driving in? Is it a bank vehicle like a CD or a money market? Is it a investment vehicle as far as is it sitting in the brokerage account or is it an insurance vehicle? Is it in an annuity, IUL, whole life? Well, how are we driving this investment? So since we're talking about annuities today, y'all, I want to make a side note. Every annuity, whether qualified or non-qualified, you have the 59 and a half rule and will pay a penalty if you're not 59 and a half. So that's what I want you guys to understand. So let's really go ahead and dive in. You know, there's three methods to pay out when it comes to an annuity, right? You have the lump sum method. You said, hey, I grew this money. Now I can decide to take this as a lump sum. Another payout method is annuitization. Now, personally, I'm not a fan of annuitization because what you do is you end up giving up your control, and the insurance company now has control over this money that you have. So I'm not a fan of annuitization. However, there's some situations where some people may be in a situation where they need to annuitize the money. However, just letting you know, I'm not a personal fan. I personally believe that you should always be in control of your money, or at least have the flexibility. And the third way for payout is exercising a withdrawal benefit rider, which is very important. A withdrawal benefit rider, just to give you guys an idea, it gives you kind of the best of both worlds, right? So let's say you have a $3,000 income stream, you're taking systematic withdrawals, and you have 300,000 as a lump sum, and you decide, oh, I need to put a new roof on, or oh, I need $20,000. You still have access to the lump sum. However, it's going to change. I don't want you to continue to think that, if you start taking all this lump sum, you're going to have money forever, or that $30,000 income stream is actually going to go down. So it's just important that you understand the methods of payout. Now, another component of an annuity or some other components is the surrender period. Now, if you're taking notes, please listen up. The surrender period is a sales charge that you must pay if you decide to sell or withdraw the complete lump sum of money out of an annuity. Now, it lasts as long as the time of the annuity, so you guys can understand that. And the surrender rates typically decrease as you get closer to the end of the surrender period. Your surrender period for an annuity is typically 7 to 14 years. So if you got a 7-year annuity, you might start with higher surrender charges. And as you get closer to the end of that period, they tend to become less and less. And here's another component. Just because it's a free withdrawal, just because you don't have complete liquidity, you do have accessibility. So a free withdrawal is a withdrawal amount that usually is up to like 10% after the first year or second year of an annuity that will not incur any surrender charges. So also you got to understand, it depends on the company, it depends on the product. So you do have a free withdrawal period. So you don't have complete liquidity, but you do have accessibility to the money. So it's important that you understand that. So there's some key things that I want you to consider when you're purchasing an annuity. Well, what are those things? Because you might say, hey, I got a lump sum of money, Dre, and I don't know what to do with it. This could be a possibility. The first thing you have to consider is the lump sum amount. It's your money, right? It's somewhere. What do you want to do with it? What's the amount? The next thing is it qualified money or is it non-qualified? Is it qualified? Is it sitting in a 401k or some type of retirement account and I need to roll it over to an annuity? Or is it sitting in my bank account, not gaining so much interest, and I want to take advantage of some of the benefits of an annuity? And another thing you must consider is your liquidity needs. That's very important because remember, you have the surrender period. The surrender period means I don't have complete access to this. So do I have any liquidity needs in the next 7 years if I can't tap into all of this money? Another component or another consideration is your age. Now, if you're 25, 30 years old, does it make sense? No, but hey, there's some situations, possibility of you might wanting to get an annuity. I personally don't think so, but as we hit the last consideration, you may think it's a good fit for you. So your age is very important. Your time horizon, it's a long-term play. It's nothing short-term about an annuity. So if you have a 7-year annuity, that means you're in that contract for 7 years. And the last consideration, which I need to mention, is your risk tolerance. And see, that's very important because if you're risk averse, you might say, hey, I want to put my money into a fixed index annuity where I don't have to worry about any losses. Now, these are good vehicles for giving you a grip on your money. You still have growth, right? You have a reasonable rate of return, right? You also have income for life and you have principal protection. So these are some things to consider. You always need to speak to your financial professional is very important because there's so many options out there, but I want you guys to understand like, hey, instead of getting a bad rap, let's educate ourselves on these different things. And the last thing I want to go over is a hypothetical example. You have your accumulation and distribution phase of your money, right? There's really 4 phases. Obviously, you have to contribute, which is the first phase. Second phase is accumulation. Third phase is distribution because you want to live off of that money. And the fourth phase is if you don't spend all your money, hopefully you are transferring money to the next generation so they won't have to start off at 0. So let's talk about how your money grows in the accumulation phase. You have a fixed way that your money can actually grow, which It's not a whole lot of growth. It's not as sexy as the next option, right? But it's a lot safer for people who are risk averse. Variable. Now, this is very exciting. This is like your money on Six Flags, right? The money's going up really high. Sometimes it's going down really fast. But, this is a way that your money can actually grow. And then you have the indexing strategy, which is kind of like the best of both of those worlds where, hey, I can lock in my gains when I get to a certain point. I'm safe. And as the market continues to rise up, I can lock in my gains to the next step, which is really good for somebody who wants to take advantage of some serious growth and still have some principal protection. So let's dive in. We're going to use an example of a 45-year-old. They're ready to retire at 65. They got a 20-year time horizon. And that money has to last them to age 100. The biggest fear, guys, is running out of money before they die. Right? Because everybody's going to die, but running out of money before you die, that's a big fear. About 66% of people they have that fear. They're afraid of that. So let's take a look. So let's hypothetically say you have a $200,000 lump sum. Remember, you need a lump sum if you're going to grow your money in an annuity. So you got 200,000. You say, hey, I'm risk averse. I want to put my money in a fixed strategy, a fixed annuity, right? And, I know it's not going to get a whole lot of growth, but hey, I'm conservative. I'm cool with it. And then you have the excited person who's like, hey, give me the ups, give me the downs. That's how I roll. I'm a high roller. So in this situation, as you can see, when you're looking at this chart, your money, now this will be beautiful if you could take full advantage of a bull run, right? Where the market is constantly shooting up, right? It'll be great. Now, the downside to a variable annuity or variable strategy is, what if you're 2 years away from retirement and all of a sudden we hit a bear market where the market starts to go down for the next 2 years? It could look like this. It's very possible. You don't know what you're going to get with variable. So it's very important that you monitor this very closely. And then the last way that your money grows is the indexing strategy, where it's like, hey, this is good. I'm going to stair step my way. It's not as exciting as variable, right? But it's not as boring as fixed. Now, let's take this 200,000 example and hypothetical returns. The fixed person says, you know what? I put in 200,000. I got 300,000. I'm cool. I didn't lose any money. I didn't make a whole lot of money. I'm cool. And then you have the person who said, man, I love the ups and downs. And this person is hoping that by the time they go to the distribution phase, that they're at the top of their game, right? You want to retire this money at the top of your game. You don't want to have a whole lot of losses. But this person, is like, okay, great, 550. However, you don't know what the market is going to do. If you're in the 2-year bear market where you're losing money, well, instead of having 550, you might end up with 350. Okay, cool. But the indexing strategy, y'all, you might end somewhere north of $450,000. Now, these are some hypothetical examples, but the key here is understanding how your money actually grows and what's more comfortable for you. Now, everybody's talking about the cost, right? How much does something like this cost, Ray? Remember, the cost can be, and annuities used to get bad raps on a lot of fees. Well, the cost nowadays could be anywhere from 0 to 2% in fees. And you're probably saying, well, what's the catch? Well, here's the catch. You got to understand this. The catch is your surrender charges, 7 to 14 years. And they're anywhere from 9 to 12%. So remember, this is a long-term play. So the catch is, hey, I'm the insurance company. I'm going to assume the risk, but your risk is going to be, you don't need this money. You have to let us use it for a period of time so we can make some money with your money, right? And you'll benefit from that. Now, it's totally different than the banks. No shot at the banks, but they use your money to make money. They leverage your money to make way more money, right? So if you're going to have somebody leverage your money, it's probably in your best interest to make sure you're getting more out of it than with somebody else leveraging your money. So options for distribution phase, I went over that a little bit, but just want to recap and give you an alternative that could be an option for somebody who has what we call these personal private pension plans. Some people call them annuities because they work like a personal private pension plan. You can take your lump sum, you can go invest it somewhere else. It's your choice. However, it's your choice. It is your money. You can spend it all. I wouldn't advise of that, but it is your money. You can do what you want with it. Then you have another option where you can take that withdrawal benefit rider. Some companies is a zero charge for that rider. Some companies, they charge for that rider. But it's an income stream. You take the paycheck for the rest of your life, which is really beautiful. Pension, personal private pension plan for the rest of your life. And if you pass away at the point where you still have money, well, guess what? Your family gets the death benefit. How cool is that? Right? Because you want to pass on that money. You don't want to pass on that money to somebody else or the insurance company or the company that you used to work for. You don't want to do that. So an income stream. And then, of course, now here's another option I didn't mention, guys, is the LTC or long-term care benefit on the money. So some states and some companies actually offer a long-term care benefit, whereas if your income stream is $3,000 a month and you end up having a long-term care need or claim, they'll turn that income stream from $3,000 to $6,000. So that's another benefit. Like I said, some companies charge for that, but whoever your advisor is or your personal financial success person or financial professional, they'll give you the good and the bad, and they should be going over the fees with you as well. So that's my time. Next week, I'll actually be doing a lunch and learn on long-term care. So make sure you tune in next Wednesday. Hopefully you guys are enjoying this day and you're going to enjoy family. And remember, don't overeat too much. I know tomorrow's Thanksgiving, but if you do, well, it's one day. It's not a holiday. It's not a holiday month. It's a holiday. So you don't have to continue to eat like that for 7 days. So, my whole thing is, I'm about faith, family, fitness, and finance, and just doing what's best for our lives. So do your best, be your best, and I'll see you guys next week.